If you inherited $40,000 tomorrow, what would you actually do with it? Almost every piece of advice you'd find says the same thing. Don't invest it all at once. Spread it out a little each month so you're not putting all that money in right before a downturn. Vanguard actually studied this question across decades of real market history. The result surprises most people, including a lot of financial advisors. Investing the full amount immediately beat spreading it out roughly 2 times out of 3. So why does almost everyone still recommend the strategy that loses more often? By the end of this video, you'll understand exactly why. And you'll have a framework for which approach is actually right for your specific situation, because the honest answer isn't simply, always do the math optimal thing. Part 1. The 2 strategies explained. Lump sum investing means exactly what it sounds like. You take the full amount of money, the inheritance, the bonus, the settlement, and invest all of it immediately in one transaction into your chosen investment. Dollar cost averaging in this specific context means dividing that same amount into equal portions and investing a fixed amount at regular intervals, say 1/12 of it every month for a year, rather than all at once. It's worth being precise about what we're discussing, because dollar cost averaging also describes something else entirely. Investing a portion of every paycheck as it arrives, which isn't really a strategy choice at all. It's just how regular income gets invested over time, since you don't have the option to invest next year's paycheck today. This video is specifically about the choice you face when you already have a lump sum sitting in cash right now and have to decide how to deploy it. Part 2. What the research actually found. In 2012, Vanguard published research examining historical market data across the US, UK, and Australian markets, testing what would have happened if an investor had a lump sum to deploy at different points across roughly the past century, comparing investing it all immediately versus spreading it out over 6 or 12 months. The finding, investing the lump sum immediately outperformed, spreading it out in approximately 2/3 of the historical periods tested. The remaining third of the time, spreading it out came out ahead, typically the periods that included a significant market decline shortly after the starting point. The reason lump sum wins more often isn't complicated once you see it. Broad markets have historically trended upward over the majority of multi-year periods. Every month you spend gradually moving cash into the market is, on average, a month spent partially out of an asset that's more likely than not to be higher next month than this one. Spreading the investment out isn't reducing risk in some neutral sense. It's trading fully invested risk for sitting in cash and potentially missing gains risk. And historically, the second risk has cost more often than it's paid off. This is genuinely one of the more well-replicated findings in this area of research. It's not one study with a surprising result. It's a pattern that holds up across multiple markets and overlapping time periods. Part 3. Why people still choose the wrong one. If the math points one direction roughly 2/3 of the time, why does almost every advisor and almost every instinct point the other way? The answer comes from behavioral economics, specifically the concept of loss aversion, formalized by psychologists Daniel Kahneman and Amos Tversky in their prospect theory research. Their core finding, the emotional pain of a loss, is felt roughly twice as intensely as the pleasure of an equivalent gain. Losing $1,000 hurts more than gaining $1,000 feels good, by a significant margin. Apply that to a lump sum decision. If you invest everything immediately and the market drops 15% the following month, that loss is vivid, attributable to a single decision, and immediately regrettable. You'll know exactly which choice caused it. If you'd spread the investment out and the same drop happened, you'd have less money exposed to it, and the experience would feel like you dodged some of the damage, even though on average across all outcomes, you'd have ended up with less money than the lump sum approach over time. This is the specific kind of asymmetry that matters here. People aren't weighing expected average outcome. They're weighing, how bad would I feel in the worst realistic scenario and how much could I have prevented it? Dollar cost averaging doesn't improve the expected outcome. It reduces the emotional intensity of the worst case scenario at the cost of also reducing the best case scenario. For a lot of people, that trade is worth making even though it's not the mathematically optimal one, which is a legitimate thing to weigh, not just a mistake. Part 4. The exact decision framework. Given both the math and the psychology, here's how to actually decide. Choose lump sum if you have a long time horizon, years, not months, genuine comfort with short-term volatility, and adding critically, confidence that you won't make an emotional, regret-driven decision, like pulling everything out, if the market drops shortly after you invest. If a 15 to 20% short-term drop wouldn't meaningfully change your behavior, the math favors going all in. Choose dollar cost averaging if this is genuinely new money you're not used to having. You have a documented tendency toward anxiety around financial decisions, or you know from past experience that watching a large invested sum drop would push you toward panic selling. In that specific case, the statistically worst strategy can still be the right one for you personally, because the version of the strategy you'll actually stick with beats the version you'll abandon halfway through. A practical middle ground, split the difference. Invest roughly half the lump sum immediately and spread the remaining half across 3 to 6 months. This captures a meaningful share of the time and market advantage that makes lump sum win more often, while still reducing the single-point regret risk that makes DCA psychologically easier for a lot of people. Worked example, Priya inherits $40,000. Full lump sum statistically gives her the best expected outcome, but she's never had this much money at once and knows she'd likely check her account daily and panic at a 10% drop. She instead invests $20,000 immediately and splits the remaining $20,000 into 4 monthly $5,000 investments, capturing most of the historical advantage of investing early, while giving herself room to adjust to having that much money invested without the full one-shot psychological exposure. Part 5. What this doesn't mean, this isn't an argument that dollar cost averaging is wrong or that anyone choosing it is making a mistake. The research describes an average across many historical periods. It doesn't predict what will happen with your specific money over your specific timeline, and a strategy you'll actually follow through on beats a theoretically better one you'll abandon under stress. It's also worth repeating, this entire discussion applies specifically to a lump sum already sitting in cash. It says nothing about whether you should be investing regularly from your paycheck. That's a different decision entirely, and the answer to that one is almost always yes, as consistently and automatically as possible. The honest takeaway isn't always invest a lump sum immediately. It's that the math and the psychology are answering 2 different questions. One is asking what produces the best average outcome, and the other is asking what will you actually be able to stick with when the market does something uncomfortable. Both are legitimate questions. Knowing which one you're actually optimizing for is the part most advice skips. So here's the one action. If you ever come into a lump sum before deciding how to invest it, honestly answer one question first. If it dropped 15% in the first month, would you stay invested or would you panic? Your answer to that determines which strategy is actually right for you, regardless of what the historical averages say. If this gave you a clearer way to think about a windfall decision, subscribe. Next video breaks down exactly how to pick the right account and fund for a lump sum like this, step by step.